Hello and welcome to Cartwright's Markets Uncut podcast, your weekly insight into the topics and issues that we have been discussing here at Cartwright. I'm Andrew Cartwright, investment manager based out of our Birmingham office, and I'm delighted to be joined by our resident podcast market commentator and head of fixed interest, Richard Carter, and welcome back Ben Barringer, our technology sector research specialist. Welcome both. So, Richard, you've been away on holiday for the past couple of weeks and must be expecting, or at least hoping, that financial markets would be somewhat quiet over the summer period, which is often the case. And today you would be gently easing yourself back into work, and that would simply be having a nice chat about where you went and what you got up to. But needless to say, it has been anything but quiet, and it has been a real rollercoaster ride for global equity markets over the past week and a half. And what with the rising going on in the UK, you must be wondering what you have come back to, although no doubt you're still keeping a watchful eye on events as they unfolded. And that turbulence all started off with a sharp sell-off in US equity markets when they opened on Thursday, the 1st of August. And this followed the release of the labour market figures in the US. And that sell-off continued throughout Friday and the Monday. And we did see a strong rebound and further recovery as last week progressed. So August seemed to have started on a fairly positive note, with the Bank of England finally cutting interest rates and continued expectations that the US Federal Reserve would be in a position to follow suit in September. We're also well over halfway into the corporate earnings reporting season, and generally that seems to be going pretty well, with many companies beating expectations. So every now and then we do get a sudden sell-off, often after a good period of strong performance, and perhaps for no obvious reasons, and that is just part and parcel of normal market behaviour. This sell-off was pretty much across the board in the US, UK, Europe, Asia, but it was notably the technology sectors, and we'll hear a little bit more about that from Ben, and Japan, where there were significant falls, and the major indices falling by 10% in technology, and Japan by nearly 20%. So, Richard, it does seem a little strange to me that those US job figures alone would cause such an adverse reaction and sudden reverse in equity market sentiment. We seem to have suddenly switched from expectations that interest rates were on track and a soft landing to concerns over a hard landing into recession. And several other possible explanations for those falls have been highlighted, including the Japanese yen carry trade, rising tensions in the Middle East, and even hurricanes have been mentioned. Richard, could you give us your take on recent events, the underlying causes and the impact on the broader financial markets? Was that US job report really so significant, or were equity markets just looking for an excuse to take some risk off the table and perhaps following a strong run, akin to the weather breaking after a particularly hot spell during the summer, which we've certainly had here in Birmingham since the weekend? Or do we have genuine grounds for concerns over a hard economic landing that are starting to emerge? Could winter be coming?
Well, I hope not. Certainly, as far as markets are concerned. I mean, I think, like you said, well, there were a number of issues that all came together at the same time to cause this massive volatility in markets. And I think, the sort of context of that, like you said, it's the summer, markets are a bit thin, liquidity is lower, and that exacerbated the moves. And there's also a number of long-held popular trades, as Ben's going to talk about, that have been going on for some time, and there was a sharp reversal in some of those. I mean, I think two issues sort of stand out for me. Firstly, US is slowing a little bit. The labour market is becoming more of a topic of conversation and replacing kind of inflation as the main, I think, focus for central bankers. And I think when you saw those weak numbers and a sort of sharp rise in unemployment rate, that led to concern that, oh dear, the Fed's too slow to cut rates. They should have cut rates already. There's going to be a policy mistake here, and that's going to tip the US into recession. That was the narrative. I think it's overblown and far too premature, because there were distortions in the numbers, and overall things aren't that bad. But yeah, that is becoming more of a concern. And then you had obviously this issue in Japan. You have what's called the yen carry trade. People borrow very low interest rates in Japan. They borrow in yen and they invest in high yielding assets, and have done very well out of it. And with the Bank of Japan deciding to raise rates, that led to a bit of an unwind in this, or a very sharp unwind in this. and a sort of associated spike in the value of the yen, which made the whole thing worse. So is winter coming? I guess not as far as the economy is concerned. I think things are slowing a little bit. I think labour market is weakening, but the Fed's got plenty of time, I think, and they'll start cutting rates, I suspect, in September. The market expects them to cut by 100 basis points by year end, which sounds to me aggressive because they've only got 3 meetings, so that means they'd have to do a 50 basis point rate cut, one of those. But I think I don't think things are too bad. The data says holding up okay. If you look at sort of concurrent estimates of GDP growth, they're still pretty strong. There's always a danger in these situations that markets talk themselves into a recession, but I think I would hope that last week's volatility starts to die down pretty quickly.
Richard, perhaps an increase in volatility was always to be expected as we approach those interest rate inflection points, with central banks facing the inevitable challenge of balancing the timing and extent of interest rate cuts with the prospect of economies tipping into recession. Now, clearly a bit of nervousness has crept in. So going forward, what should we be looking out for in terms of economic data, and how might that influence central banks' interest rate decisions?
I think that's spot on, actually. I think that around the timing of changes in monetary policy, when you go from sort of hiking to being on hold to cutting, that's always a danger point, I think, for sort of market volatility. And I think we've sort of seen that again. And then, you've got Japan raising rates and the Fed potentially cutting them. So things that can create these wobbles in markets. I think the things to look out for, still inflation. We've got inflation numbers this week in the US and the UK. Still worth keeping an eye on those, because hopefully if they're relatively benign, that opens the door for rate cuts pretty soon. But then I think, increasingly, as I say, the focus is on the labour market in the US. And so, we won't get much jobs data. I'll get some this week, jobless claims and stuff, but we'll have to wait a while for the next payrolls numbers. But I think those will be the main things. And I think as far as the Fed's concerned, if the labour market keeps weakening, inflation behaves okay, we can expect a rate cut fairly soon.
Thank you, Richard. So as we mentioned, the technology sectors were one of the key areas that bore the brunt of that sell-off, with some of the key indices, tech indices falling by nearly 10%. So I'm very pleased to welcome back Ben Barringer, technology analyst, for an update. So Ben, having spoken with Oswald on a podcast just a few weeks ago, thank you so much for joining us again. I think this really highlights how significant the technology sectors are, not just for the US, but global equity markets. And with, once again, technology stocks playing a leading role in market movements, there's never a dull moment. And no doubt last week was very busy for you, with the market turbulence, company reporting, and your appearance on BBC News commenting on Disney's results. So, Ben, when you spoke with Oswald, the reporting season for tech sector was just underway. And I think it's fair to say that with valuations across the sector, there was such that any signs of companies not meeting market expectations at the very least, that would leave share prices somewhat vulnerable to a setback. And you commented at the time there had been a little weakness in the sector. So since then, there have been several more companies reporting. Could you provide a further update on those results and how the companies have fared? And more generally, your thoughts on that sharp sell-off? Could disappointing results have been a contributing factor to that sell-off? Or was it more simply just a symptom of wider events?
Yeah, good morning, Andrew. So yeah, absolutely. Look, the tech sector is a high-performing, high-growth area of the market, and even the Mag 7 is still growing at very strong levels. Profitability and return on invested capital is also high, but I've covered the tech sector for 25 years, and so unfortunately, with that high return and that high performance also comes relatively high risk as well. And so 10% setbacks in the tech sector are not uncommon. In fact, if you look back over the last 5 years, there's been a number, and it's really important that people keep their feet on the ground and expectations well anchored around what's really happening. And I think we've got some, going into these set of numbers, we've had some quite high expectations, and some of them were met and some of them were beaten, but sometimes a meet isn't quite as good as people have been expecting. The buy side in the market gets a little bit more excited than maybe it should be, particularly around sort of cloud capex. People were expecting another big raise in cloud capex, which is driving the underlying AI trade, and there have been raises, but not the same magnitude that we saw. And so that, if you will, the second degree or the second derivative of growth for tech spending has maybe started to slow a little bit. Now, I talked last time I was on about the Google results, which were a little bit of a tale of two cities, really. Search was fine and YouTube was a little bit weak. Since then, we've had Meta. They had a great set of numbers, actually, a very buoyant ad market, and Meta, we think, has got a lot of AI optionality. Microsoft also had numbers. The key number there is the 30% growth in their cloud business called Azure. They actually, interestingly, and I think this is very interesting, they're now guiding for the next 12 months, and they've guided to a slight slowdown over the next 6 months, so to sort of 28, 29%, but then a re-acceleration in the second half. And we, as we go into 2025, we think that is a function of the Microsoft Copilot and them generating revenues there. So we think the setup for Microsoft is still pretty strong. We've also had Amazon numbers, which were weak in the e-commerce business, but very strong in the Amazon Web Services business. A standout 19% growth there. Remember, AWS is the biggest of the cloud providers. And then in terms of the wobbles and so forth, there was a little bit of signal and a little bit of noise. The noise was things like Warren Buffett selling some of his stake, or half his stake in Apple. That's consistent though with his recent trading. He tends to buy Apple when it's in the low 20s multiple and sell it when it's in the high 20s or low 30s multiple, and so that's no surprise to us. We've also had concerns around a delay in one of the Nvidia next generation products. It looks like there is a bit of a delay there, but the great thing about Nvidia's product line is that the current product, which is it's shipping very well, as there's no production problems with that. We think that there'll just be a substitution into that current product while there's a delay in that new product, so we're not too worried about that. In terms of the sort of key signal, though, I think it's really important to think about the macro data that Richard was just talking about. People are very content with the US economy gradually slowing as long as the jobs market doesn't crack, and so that weak jobs data that we saw was a concern for the markets, and of course for the higher beta, the higher growth tech names as well. We have also seen slightly slower data in software sales. We also saw that in some consumer names, and also I'd highlight travel as well. You mentioned the Disney results. They had a very weak parks data. The Disneyland, Disney World have seen a very good, strong set of numbers since COVID, as everybody's returned back to doing all the holidays that they couldn't do while they were locked down. But now macro and household spending is starting to bite there. So we also saw weak data from Airbnb and TripAdvisor. So yeah, look, I think the macro is the real signal here. There have been some other noisy events as well.
Ben, it seems to me that there is a tendency for technology stocks all to be sort of bundled together, particularly when there's so much momentum behind the share prices. And we tend to get terms such as Magnificent Seven being sort of thrown around. But in reality, and as you already sort of touched upon, they are quite different businesses with different drivers. And if we look at Amazon, it is essentially a retailer that is enabled by technology. And as you often sort of remind us, many tech stocks are cyclical. And we might be sort of entering into a bit of a slowdown, but are there any subsectors that you think are particularly exposed to changes in the macro environment, or perhaps are less immune to changes?
Yeah, look, you're absolutely right. I dislike the Mag 7 grouping anyway, because within that there are some very different businesses. We like Microsoft, we like Amazon, we like Meta, but we don't particularly like Apple. We certainly don't like Google, and Tesla as well. We think is fraught with not only management risk, with Elon being fairly hard to predict, but also there's a new product supposed to be coming in terms of electric vehicles, and that's quite hard to work out where the demand for that is coming from. So look, overall, it's very important to be selective when you're thinking about the Mag 7. In terms of the structural versus cyclical, I think this is a really important point. It's easy to think that technology is just all about structural changes, cloud computing or artificial intelligence or digital transformation. And those definitely are drivers. And I would expect over the next 5-10 years that the average company spends more of its sales on technology. However, the very fact that technology spending is a function of corporate profitability tells you that it's a cyclical. And if I look at the Mag 7 just as an example, they are exposed to IT spending, they're exposed to consumer spending, and they're also exposed to advertising, particularly obviously digital advertising. All of those are cyclical. And so it's very important that we pass out and try and look for the companies that are going to do better than that, but with a very careful eye on the fact that these are not defensive businesses particularly, they are cyclical businesses.
And finally, Ben, you mentioned Google recently announced their results, but I think last week they also had they faced an antitrust court ruling. Could you tell us a little bit more about that and the potential implications of that outcome?
Yeah, absolutely. So this has been a long rolling case with the Department of Justice, the DOJ, and they have basically found in their ruling that Google has a monopoly in search, principally because it's the default search engine in Android and in iOS. In fact, Google pays Apple about $20 billion a year for this status. So that $20 billion is about 5% of Apple's sales, and it's about 17% of Apple's sales. So Apple is very much caught up in this DOJ investigation. In return, Apple provides about 36% of Google's search traffic, and that's about 15 to 20% of Alphabet, the holding company of Google, of Alphabet's revenues. And so, this is a big deal for both Apple and for Google. The appeal, it looks like Google will appeal, and that's going to take at least 6 months. So this is going to be a very protracted case, and we probably don't expect a resolution for at least a couple of years. The most important thing that people are focused on is, what remedy, what changes are the DOJ going to ask for? Probably the bull case for Google stock is actually that it just does what the DOJ just asked for, what Europe has asked for, and that's to give subscribers or users the option to select whichever search engine they want. So Google has an 86% market share in what it does, and there are other options, Yahoo and Bing and so forth. And in Europe, there's a thing called DuckDuckGo as well. The problem is that because Google is the biggest, it's also the best in terms of the ability to generate, better search queries or search outcomes. So generally what's happened in Europe is people have been given the option, but they've still chosen Google. So actually Google's market share of 86% hasn't changed very much. The bear case, and the thing we worry about, and I think the market worries about, is of a much more draconian nature. So some kind of separation of search and advertising, and those two things are very linked for Google. So we think that that's going to put a cloud on Alphabet's stock. We also, as well, worry about the long-term risk from AI for Google. Although Google has some excellent AI assets, as people start to use more AI assistants, there's a risk that they start to use other search engines, or the time they spend is spent not on Google, and time spent translates generally into dollars. So we much prefer companies like Meta and Netflix. Finally, just quickly, final thing to say, next setup for the big tech area is NVIDIA's results. Those are on the 28th of August. We still expect them to beat. There'll be a lot of focus on their latest product, Blackwell. But so far we've been seeing, if you look in the supply chain, we've been seeing some quite good numbers from the NVIDIA supply chain. So we're not too concerned about NVIDIA at this time. I'll leave it there, Andy. Thank you.
Good. So Ben, Richard, thank you very much for your insights today and for what has been a sort of fascinating and very turbulent period. So before we draw to a close, if any listeners have any questions that they would like to ask one of our analysts for a future podcast, you can put your questions forward to our team of experts by submitting them via the weekly comments page on our website. We'd love to hear from you. To stay up to date with our thoughts on markets and current issues, please visit our website at www.quillachieveit.com. Here you can also see more of what we're doing at Quill Achieve It, as well as watch past webinars on demand and subscribe to our weekly comment newsletter. We'll be back again next week. And in the meantime, for those of you on social media, you'll be able to see up-to-date content on our Facebook, Instagram, Twitter, and LinkedIn pages. Thanks again to our Head of Fixed Interest, Richard Carter, and to Ben Barringer, Technology Analyst. And you all for listening.